Question 1. A life insurance policy's free look provision primarily serves to protect the A. Insurer, by allowing a review of the application. B. Producer, by ensuring commissions are earned quickly. C. Policy owner, by allowing time to review the policy terms with an option to return it for a full refund. D. Beneficiary, by guaranteeing the policy is in force immediately. Answer: C. Policy owner, by allowing time to review the policy terms with an option to return it for a full refund. The free look provision, often called the 10-day free look, is a consumer protection feature that gives the policy owner a specific period, usually 10 days from policy delivery, to review the newly issued policy. If the policy owner decides it's not suitable for their needs during this period, they can return it to the insurer for a full refund of any premiums paid. This ensures that consumers are not locked into a policy they don't understand or want, emphasizing the importance of reviewing policy details promptly after issuance. Always remember that this provision is a key right for the policyholder. Question 2. All of the following are characteristics of a participating life insurance policy, except A. It is issued by a mutual insurance company. B. Policy owners may receive dividends. C. Dividends are guaranteed and taxable. D. It pays a fixed death benefit. Answer: C. Dividends are guaranteed and taxable. Participating policies are issued by mutual insurers and are designed to participate in the company's surplus, which can lead to dividends being paid to policy owners. While these policies pay a fixed death benefit, the key characteristic being tested here is the nature of dividends. They are never guaranteed and are generally considered a return of unearned premium, thus usually not taxable income. Understanding that dividends are not guaranteed and their tax treatment is crucial for the exam. Question 3. Under a major medical insurance policy, the corridor deductible applies. A. After the basic medical expense benefits are exhausted and before coinsurance begins. B. Before any basic medical expense benefits are paid. C. Simultaneously with the basic medical expense deductible. D. Only to inpatient hospital stays, not outpatient services. Answer: A. After the basic medical expense benefits are exhausted and before coinsurance begins. A corridor deductible is a specific type of deductible found in comprehensive major medical policies, which combine basic coverage with a major medical component. It bridges the gap between the exhaustion of the basic policy benefits and the point where the major medical coverage's coinsurance provision begins to apply. This means the insured must pay this additional deductible amount out of pocket after their basic coverage pays out but before the major medical policy starts sharing costs through coinsurance. Think of it as a separate, additional deductible you pay after basic benefits are used up. Question 4. Which settlement option provides a beneficiary with income payments for a stated period of time or for their lifetime, whichever is longer? A. Interest-only option. B. Fixed period option. C. Fixed amount option. D. Life income with period certain option. Answer: D. Life income with period certain option. The life income with period certain settlement option provides the beneficiary with guaranteed income payments for their entire life, but also guarantees that if the beneficiary dies before a specified period, that period certain, the remaining payments for that period will be paid to another designated recipient. This option combines the security of lifetime income with the assurance that a minimum number of payments will be made, regardless of how long the primary beneficiary lives. It's a common choice to ensure both lifelong support and some benefit for heirs. Question 5. An adjustable life insurance policy combines features of A. Term life and universal life. B. Whole life and term life. C. Variable life and whole life. D. Universal life and variable life. Answer: B. Whole life and term life. Adjustable life insurance is a flexible policy that allows the policy owner to adjust various policy elements, such as the face amount, premium, and period of protection. This flexibility stems from its unique design, which permits it to function as either term insurance, by adjusting the premium or coverage period, or whole life insurance, by accumulating cash value. It's a versatile policy that can be adapted to changing needs, offering a blend of permanent and temporary coverage characteristics. Question 6. A deferred annuity contract states that the annuitant will receive payments beginning in 15 years. Which of the following is true regarding this contract during the 15-year period? A. The annuitant cannot make any additional premium payments. B. The cash value is not accessible during this time. C. The contract is in the accumulation period. D. The annuitant is receiving income payments. Answer: C. The contract is in the accumulation period. A deferred annuity is designed to postpone income payments until a future date, such as retirement. During the period before payments begin, the funds contributed to the annuity grow on a tax-deferred basis, and this phase is known as the accumulation period. The annuitant might be able to make additional premium payments or even access the cash value, but the defining characteristic of this period is the growth of the principal before annuitization. Remember, deferred means payments are put off until later, and that later is the annuitization period. Question 7. A producer advises a client to replace an existing life insurance policy with a new one that offers a lower premium, but fails to inform the client about the new policy's higher surrender charges and loss of existing cash value accessibility. This action is considered A. Rebating. B. Twisting. C. Churning. D. Misrepresentation. Answer: B. Twisting. Twisting is the unethical practice of inducing a policy owner to lapse, forfeit, or surrender an existing policy to purchase a new one with another insurer, typically to the detriment of the insured. In this scenario, the producer omitted crucial information, higher surrender charges, loss of cash value accessibility, that would make the replacement disadvantageous for the client, which is a hallmark of twisting. It's crucial to always disclose all material facts to clients, especially when considering policy replacements. Question 8. A health insurance policy provision that states the insurer will pay only for medical expenses incurred in excess of the amount payable under another primary health insurance policy is known as A. Elimination period. B. Co-insurance clause. C. Coordination of benefits, COB, clause. D. Subrogation clause. Answer: C. Coordination of benefits, COB, clause. The Coordination of Benefits, COB, clause is a provision found in group health insurance policies that prevents multiple insurance plans from paying more than 100% of the actual incurred medical expenses. When an individual is covered by more than one group health plan, the COB rules determine which plan is primary and which is secondary, ensuring that combined payments do not exceed the total medical costs. This prevents overinsurance and ensures fair payment distribution among multiple insurers. Question 9. Which of the following statements is true regarding a life insurance policy loan? A. Policy loans accrue interest and reduce the death benefit if not repaid. B. Policy loans are taxable income to the policy owner. C. Policy loans automatically terminate the policy if unpaid. D. Policy loans are not available on whole life policies. Answer: A. Policy loans accrue interest and reduce the death benefit if not repaid. Policy loans are available on permanent life insurance policies, like whole life, that have accumulated cash value. When a loan is taken, the cash value serves as collateral, and the loan accrues interest. If the loan, plus any accrued interest, is not repaid by the time of the insured's death, the outstanding balance is deducted from the death benefit paid to the beneficiary. This is a common feature allowing access to policy cash value without surrendering the policy. Question 10. All of the following are essential elements of a legal contract, except A. Offer and acceptance. B. Legal purpose. C. Consideration. D. Unilateral agreement. Answer: D. Unilateral agreement. A unilateral agreement describes a characteristic of an insurance contract, where only one party, the insurer, makes a legally enforceable promise, and the other party, the insured, is not legally bound to pay premiums but will lose coverage if they don't. The four essential elements required for any contract to be legally binding are offer and acceptance, agreement, consideration, exchange of value, legal purpose, and competent parties. Unilateral is a feature of an insurance contract, not a foundational element of contract formation. Question 11. What is the primary purpose of an annuity suitability requirement? A. To ensure an annuity's payout option is financially guaranteed. B. To protect insurers from claims of misrepresentation. C. To determine if the annuity product aligns with the client's financial situation, objectives, and needs. D. To verify the producer holds the correct license to sell annuities. Answer: C. To determine if the annuity product aligns with the client's financial situation, objectives, and needs. Annuity suitability is a regulatory requirement designed to protect consumers by ensuring that the annuity product recommended or sold to a client is appropriate for their specific financial situation, investment objectives, and risk tolerance. Producers must gather comprehensive information about the client's financial background before making a recommendation. This helps prevent clients from purchasing products that are not in their best interest, especially given the long-term nature of annuities. Question 12. A policy owner changes the beneficiary designation on their life insurance policy from their spouse to their child. This is an example of which policy provision? A. Assignment clause. B. Reinstatement provision. C. Ownership rights. D. Change of beneficiary provision. Answer: D. Change of beneficiary provision. The change of beneficiary provision allows the policy owner, while the insured is living, to change the designated beneficiary who will receive the death benefit. Unless the beneficiary designation was irrevocable, the policy owner has the right to make such changes without the beneficiary's consent. This flexibility is a key aspect of policy ownership, allowing the policy to adapt to life changes. Question 13. Which of the following is considered a primary purpose of HIPAA for health insurance? A. To regulate the solvency of health insurance companies. B. To ensure portability of health coverage and protect privacy of health information. C. To establish national standards for health insurance premiums. D. To mandate all employers offer health insurance benefits. Answer: B. To ensure portability of health coverage and protect privacy of health information. HIPAA, the Health Insurance Portability and Accountability Act, has two main goals relevant to health insurance. First, it ensures the portability of health coverage, allowing individuals to maintain coverage when changing or losing jobs. Second, and crucially, it establishes national standards for the privacy and security of protected health information, PHI, restricting how health plans, healthcare providers, and other entities can use and disclose patient data. Think of HIPAA as safeguarding your health coverage continuity and your medical privacy. Question 14. An insured has a Social Security blackout period. This refers to the period A. When Social Security benefits are temporarily suspended due to a disability review. B. Between the time the youngest child reaches age 16 and the surviving spouse reaches age 60. C. When Social Security disability benefits are not available to a worker after an accident. D. After retirement, before Medicare benefits begin at age 65. Answer: B. Between the time the youngest child reaches age 16 and the surviving spouse reaches age 60. The Social Security blackout period refers to the time frame during which a surviving spouse with dependent children is no longer eligible for Social Security survivor benefits. This period typically begins when the youngest child reaches age 16, or 18 if still in high school, and ends when the surviving spouse reaches age 60, unless they are disabled. It creates a potential income gap for the surviving family, often addressed by life insurance planning. Question 15. A producer completes an application for a life insurance policy and collects the initial premium. The producer issues a conditional receipt to the applicant. Which statement is true regarding the coverage effective date with a conditional receipt? A. Coverage is effective immediately, regardless of insurability. B. Coverage is effective only after the policy is delivered and accepted by the applicant. C. Coverage may be effective as of the date of application or completion of medical exams, provided the applicant is found insurable. D. Coverage is effective only if the applicant dies before the policy is issued. Answer: C. Coverage may be effective as of the date of application or completion of medical exams, provided the applicant is found insurable. A conditional receipt provides interim coverage to the applicant from the date of application or medical exam, whichever is later, provided the applicant meets the insurer's underwriting standards as of that date. If the applicant is found insurable, coverage retroactively applies to that earlier date, even if the policy hasn't been formally issued yet. This protects the applicant by offering coverage during the underwriting period, but only if they would have been approved. Question 16. A policy owner's right to change the beneficiary, borrow against the cash value, or assign the policy is known as A. Absolute assignment. B. Collateral assignment. C. Policy ownership rights. D. Revocable beneficiary rights. Answer: C. Policy ownership rights. Policy ownership rights refer to the privileges and control that the policy owner has over a life insurance policy. These rights typically include the ability to name and change beneficiaries, take out policy loans against the cash value, assign policy rights to another party either absolutely or collaterally, and select dividend or settlement options. These are fundamental powers that differentiate the policy owner from the insured or beneficiary. Question 17. The incontestability clause in a life insurance policy prevents the insurer from doing what after a specified period, typically 2 years? A. Denying a claim for death benefits. B. Denying a claim based on material misrepresentations in the application. C. Increasing the policy's premium. D. Changing the policy's terms and conditions. Answer: B. Denying a claim based on material misrepresentations in the application. The incontestability clause states that after a life insurance policy has been in force for a specific period, usually 2 years, the insurer cannot contest the validity of the policy or deny a claim based on material misrepresentations or concealments made by the insured in the application, unless it was a fraudulent misstatement. This provision protects the beneficiary from future challenges to the policy's validity by the insurer, ensuring certainty of coverage after the contestable period passes. Question 18. An insured suffers an injury that prevents them from performing any occupation for which they are reasonably suited by education, training, or experience. This is defined as A. Partial disability. B. Own occupation disability. C. Any occupation disability. D. Presumptive disability. Answer: C. Any occupation disability. Any occupation disability is a stringent definition used in some disability income policies, meaning the insured must be unable to perform the duties of any occupation for which they are reasonably qualified by education, training, or experience. This is a more restrictive definition than own occupation disability, which typically only requires the insured to be unable to perform their current job. Understanding these definitions is key to assessing the breadth of disability coverage. Question 19. All of the following are typically included in a policy's grace period, except A. The policy remains in force. B. Premiums are due during this time. C. A claim will be paid, less any overdue premium. D. The policy will automatically lapse if premiums are not paid by the end of the grace period. Answer: C. A claim will be paid, less any overdue premium. While a grace period ensures that coverage continues for a short time after a premium due date, usually 30 or 31 days, the insurer does not typically deduct an overdue premium from a claim paid during the grace period for most life and health policies. The purpose of the grace period is to give the policy owner extra time to pay the premium before the policy lapses. If a claim occurs, and the premium is unpaid but still within the grace period, the policy is still in force and the full benefit would be paid. Question 20. When an insurer uses the adhesion characteristic of an insurance contract, it means that A. The contract is legally binding on all parties involved. B. The contract is drafted by the insurer and accepted, as is, by the applicant. C. The contract involves an unequal exchange of value between parties. D. Only one party makes a legally enforceable promise. Answer: B. The contract is drafted by the insurer and accepted, as is, by the applicant. An insurance contract is a contract of adhesion, meaning it is prepared by the insurer, the stronger party, and submitted to the applicant, the weaker party, on a take-it-or-leave-it basis. The applicant has no ability to negotiate the terms of the contract. If there's any ambiguity in the contract, courts usually interpret it in favor of the insured because the insurer drafted it. This characteristic highlights the insurer's control over the policy language. Question 21. Which of the following statements about a variable life insurance policy is most accurate? A. Its cash value growth is guaranteed and invested in the insurer's general account. B. Its death benefit is fixed, but the cash value fluctuates based on separate account performance. C. It requires a securities license to sell due to the investment of cash values in a separate account. D. Policy loans are not permitted on variable life policies. Answer: C. It requires a securities license to sell due to the investment of cash values in a separate account. Variable life insurance policies are unique because their cash values are invested in a separate account, typically comprised of various subaccounts similar to mutual funds, chosen by the policy owner. Due to the investment risk associated with these separate accounts and the fact that the cash value and potentially the death benefit can fluctuate, selling variable life policies requires producers to hold both a state life insurance license and a FINRA, securities, registration. This dual licensing requirement emphasizes its nature as both an insurance product and a securities product. Question 22. Which of the following is not a typical characteristic of a group life insurance policy? A. It is usually offered as term coverage. B. The employer typically owns the master policy. C. Individual policy certificates are issued to employees. D. Evidence of insurability is always required for each employee. Answer: D. Evidence of insurability is always required for each employee. A key characteristic of group life insurance is that it typically offers coverage to a group of individuals, e.g., employees of a company, without requiring individual evidence of insurability, especially if employees enroll during the eligibility period. This "no evidence of insurability" feature is a significant advantage, particularly for those who might otherwise be uninsurable, and it works due to the law of large numbers. Individual certificates are issued, but the employer holds the master policy, and it's generally term coverage. Question 23. The purpose of the misstatement of age or gender provision in a life insurance policy is to A. Allow the insurer to void the policy if the age or gender was incorrect. B. Adjust the death benefit to what the premium would have purchased at the correct age or gender. C. Refund premiums if the age or gender was stated incorrectly. D. Increase the premium if the insured was found to be older or a different gender than stated. Answer: B. Adjust the death benefit to what the premium would have purchased at the correct age or gender. The misstatement of age or gender provision is a standard clause in life insurance policies that addresses situations where the insured's age or gender was incorrectly stated on the application. Instead of voiding the policy, this provision allows the insurer to adjust the death benefit amount to reflect what the premiums paid would have purchased at the insured's correct age and gender. This ensures fairness and prevents either party from gaining an unfair advantage due to the error. Question 24. An agent's fiduciary duty to an insurer involves all of the following, except A. Promptly remitting premiums to the insurer. B. Avoiding conflicts of interest. C. Acting in the best interest of the client, even if it conflicts with the insurer's directives. D. Accurately completing applications and providing all material facts. Answer: C. Acting in the best interest of the client, even if it conflicts with the insurer's directives. While an agent certainly has an ethical responsibility to their client, their fiduciary duty specifically refers to their legal and ethical obligation to act in the best financial interest of the insurer they represent. This includes prompt remittance of premiums, avoiding conflicts of interest that could harm the insurer, and accurately reporting all material facts relevant to underwriting. The agent's duty to the client is one of suitability and good faith, but the fiduciary relationship is primarily with the principal, the insurer. Question 25. Which of the following actions constitutes an illegal, rebating, practice? A. Sharing commissions with another licensed agent on a joint sale. B. Offering a client a free insurance policy review as part of the sales process. C. Returning a portion of the premium or offering something of value not specified in the policy as an inducement to buy. D. Providing a client with a gift of nominal value, such as a pen or calendar, after a sale. Answer: C. Returning a portion of the premium or offering something of value not specified in the policy as an inducement to buy. Rebating is the illegal practice of returning a portion of the premium or offering any item of value not specified in the policy as an inducement for a client to purchase insurance. This practice is prohibited because it can lead to unfair discrimination among policyholders and undermines the actuarial basis of insurance rates. Remember, the core issue with rebating is providing an unauthorized incentive to purchase a policy.